Why the US economy is on the cusp of a real recovery and why you should be excited in 2026. Imagine an economy that feels stable, where inflation is cooling, jobs are holding up, businesses are investing again, and markets are starting to rally. Well, that's not a dream. It's unfolding right now. Today, we're going to unpack why the US economy could be entering a period of real recovery in 2026 and why that matters for your money, your job, your investment portfolio, and your future. Stick with us, because what you're about to hear isn't fear. It's financial optimism backed by real data. And by the end of this video, you'll understand the forces pushing the economy forward, not backward. Section 1. Inflation is cooling. Let's start with what everyone feels in their wallet. Inflation. In recent economic data, the Consumer Price Index, CPI, slowed more than most economists expected. In January 2026, inflation came in around 2.4% annualized, below forecasts, signaling that price increases are finally tapering. That's huge, because inflation that sticks around above the Federal Reserve's 2% target makes everyday goods, groceries, gas, rent, feel expensive. But as inflation slows, two big things happen. One, buying power stabilizes. Consumers can stretch their dollars further, easing pressure on household budgets. Wages growing faster than inflation means people actually come out ahead, not behind, on their purchases. 2. Interest rates get room to move. When inflation cools, it gives the Federal Reserve more flexibility to eventually cut interest rates. Lower interest rates make borrowing cheaper for homes, cars, small businesses, and even corporate expansion. Markets responded enthusiastically to this easing, with major stock indices stabilizing and even rebounding after the data was released. Think about what that means. Less inflation, more consumer confidence, potentially cheaper loans, stronger business growth. That's a virtuous cycle every investor dreams about. Section 2. The labor market, strength in stability. Another key piece of the economic puzzle is the labor market. It may sound odd, but here's the good news. While hiring isn't skyrocketing like a few years ago, the labor market isn't collapsing either. It's entering a state economists call a balanced slowdown. In other words, job growth is normalizing, not nosediving. What's important here is that wage growth continues. Average wages are rising faster than inflation in many sectors, meaning real income is improving. That boosts consumer spending without adding undue inflationary pressure. Employers are not slashing jobs. Initial jobless claims are consistent with long-term trends. This suggests layoffs aren't rampant and employers are holding on to their workforce. Job market cooling can lead to rate cuts. A labor market that's solid but not overheating gives the Fed room to pause rate hikes and potentially cut rates later in 2026. This is exactly what markets want to see, a soft landing, not a recession. This calm in the job market doesn't feel explosive, but it's sustainable. It's not boom and bust. Instead, it's steady growth where people can plan, spend, and invest with confidence. Section 3. Markets respond positively. Of course, all this data, inflation cooling, steady jobs, feeds directly into financial markets. In the immediate wake of better-than-expected inflation readings, markets stabilized and gained back lost ground. Major indexes like the Dow Jones Industrial Average and S&P 500 showed positive moves as investors interpreted the data as a sign of a more accommodative policy future. Here's what's exciting. 1. Higher odds of rate cuts. When inflation fades and jobs remain stable, markets start pricing in the possibility that the Federal Reserve will cut interest rates later this year. Lower rates often boost growth stocks, housing demand, business investment, consumer loans. 2. Stocks rally on relief data. After the latest CPI report, the S&P 500 and Dow showed solid upward pressure, indicating traders are optimistic that any market downturn might have already been priced in. 3. Rotation into broad market strength. Stocks aren't just rising in one sector. Rotation is happening where industries like consumer discretionary, financials, and industrials are participating in gains. That signals confidence across the economy, not just in one narrow group of high-flying tech names. Imagine the markets like an engine, When more cylinders start firing together, the machine runs smoother and stronger. That's what's happening here. Section 4, Consumer and Business Optimism. Let's turn to sentiment, because markets and data tell one part of the story, but people's expectations tell the other. Recent surveys show that Americans are increasingly optimistic about stock market gains and economic growth this year, a notable rebound from more pessimistic views last year. Here's why that matters. Confidence drives spending. If people believe the economy is improving, they always spend more on goods and services, invest more in markets and retirement accounts, feel safer starting businesses and hiring employees. Businesses plan expansion. When business leaders see stable inflation and predictable policy, they invest in capital expenditures, hiring plans, innovation, and product development. That's a key reason why Wall Street strategists and CEOs, like the chief executive of Goldman Sachs, are publicly optimistic about the economic backdrop for 2026, citing business activity and investment willingness. Section 5. Why 2026 could be a turning point. Let's talk big picture. Why is now the moment when the U.S. economy could be turning a corner? 1. Disinflation is real. Inflation has been the dominant economic story for years. If it continues easing, that alone improves living standards and lowers uncertainty. 2. The Fed has more flexibility. With inflation closer to target and jobs stable, the Fed can pivot from fighting inflation to supporting growth, potentially with interest rate cuts later in the year. 3. Consumer and business activity are strong. Despite uncertainty, many sectors are showing resilience. Retail sales, retail optimism, and household spending remain meaningful contributors. 4. Markets are valuing future growth. Even amid short-term volatility, investors are beginning to price in prolonged growth, not recession, for the U.S. economy. Some forecasts even project GDP growth stronger than expected, with expanding economic output compared to earlier estimates. So what does this all mean for you, the viewer? Inflation is cooling. Jobs remain stable. Markets are responding positively. Business and consumer optimism is rising. Economists and CEOs are starting to sound upbeat. That's not hype. That's real, data-backed momentum. If you're an investor, this could be the moment to reevaluate your strategy with a longer-term growth lens. If you're a worker, this means stability and possibly better wage purchasing power. If you're an entrepreneur, it's a time to expand, innovate, and capture growth where others hesitate. This is not just recovery, it's renewed opportunity. So here's what we want you to do next. Hit like if you're excited about economic recovery. Comment below with your market predictions for 2026. Subscribe for weekly updates on how these trends evolve, because the story of 2026 could be one of growth, confidence, and financial opportunity, and we'll be here every step of the way. Thanks for watching. If you want more deep dives on markets, economy, and personal finance opportunities, hit subscribe and turn on notifications. See you in the next video. This is Felix. See you next time.